All right, guys, welcome back to another episode. Today, I've got some really exciting stuff planned for us. Jay and Jason are here in the studio with us virtually. We've been dealing with tech issues, but my gosh, we are here and we're going to provide hopefully a lot of value to you today. And so what we're going to be talking about is a very advanced strategy. This is called intergenerational split dollar. It's the use of life insurance across generations with some trust structures. But thankfully, I've got two very competent, very good gentlemen in the building today that are going to help break this complex issue down. So Jason, Jay, feel free to introduce yourself. Jason, we'll start with you briefly.
Thank you, Alden. Jason Prather. I'm a managing principal of Legacy Capital Group here. I'm based in Little Rock, Arkansas, but we work all over the country. And I've been in the insurance business and at Partners Financial since 2003.
So a short period of time. Yeah. What about you, Jay?
Yeah, Jay Cavanagh, wealth transfer advisor with NFP, National Financial Partners, and starting my 35th year. And like Jason, our practice is national, but tend to focus in the upper Midwest.
Amazing. Well, I think on Jason's side of the house, I've been alive longer than he's been practicing, but I can't say that about you, Jay. you got me trumped there, my friend. But I'm excited.
I practiced law for 12 years before I got into the insurance business.
So that puts you into 91?
1991. What?
Yeah.
All right, cool. So yeah, I haven't been around that long. Anyway, moving on. Appreciate you both being here and the expertise that you're going to bring today. We're going to pull up a document on the screen for everybody to take a look at, and we're going to walk through it. Jason's going to kind of run point on this with his legal background, and we're going to describe something that is, like I said before, it's complicated. This is not something that, hey, if you've got some money from your strong W-2 income, you're probably not going to be looking at this strategy. This strategy is something where we have a lot of capital, a high net worth, generational wealth across families, and we're dealing with estate tax problems. And so, Jason, if you would, as we start to look at this diagram here, would you break down let's say the ideal avatar that someone would need to fit in order to even consider a strategy like this?
Sure. So this strategy is purely a very, very effective, but somewhat complex wealth transfer strategy. And the whole premise is you have people that are going to be paying estate taxes, right? And so in order to pay estate taxes, because where the estate exemptions have gone to, you need to be very wealthy. So this is a strategy that a lot of very wealthy people are utilizing. It helps because if you're insuring a large life insurance policy and you have a very large premium, there are a lot of complexities that go into getting that premium into the trust to pay the life insurance premiums. There's gifting limitations and other limitations. So when you have a situation where you have a wealthy generation one that's going to be paying estate taxes, and their generation two has their own wealth and their own estate tax issues, we can effectively help reduce the estate taxes on the generation one and fund the estate tax liability on generation two without generation two really having to spend any money, right? So we're going to use grandmom's money to reduce her taxable estate to ensure grandson and granddaughter and their families. So when they pass, there's a liquidity that's already funded in there to pass their wealth on to grandkids. In a nutshell, that's basically the concept. Jay may want to expand on it.
Yeah, Alden, in the simple sense, and it depends on if you live in a state where there's a state estate tax like in Minnesota, but at the end of the day, if generation one is down to their last dollar, they know if they leave it in their estate, they're going to lose 40 or 50 cents of that dollar.
Mm-hmm.
However, if they employ a strategy like this, basically that'll reduce the estate tax down to about 10 cents. And then the 90 cents in savings is really what fuels and funds the death benefit for generation two.
Okay. So we're looking at, let's say, ballpark ranges that won't hold you to it, but maybe a 75% reduction in the estate taxes, down from 40 to 10% is kind of what we're talking about here. If we could throw out some real numbers, we can kind of get an idea of what this would actually look like. Let's say generation one is worth $100 million. They've got a $30 million exemption. And so $70 million would be subject to estate tax unless some additional planning is done. walk me through this chart and what we're actually doing to get that 70 million liability and the 50% taxation of those dollars down to a smaller percentage. You can walk me through that, please.
Sure. And this is not something that you would typically be able to fund with the full $70 million amount that you're talking about. There's lots of other estate planning that person's going to have to be doing. But
Right.
this is something that they can also do because it's tied to the secondary problem that their children are going to have and their grandchildren are going to have, right? And so if you have $70 million, and let's say that she has 3 grandchildren or 3 children, and each of them are married and they've got grandchildren and so forth, she could take maybe, say, $10 million of her 70 that's taxable and use it and create 3 separate intergenerational split dollar transactions for these children. That $10 million, depending upon the ages of their children and spouses, could purchase a massive amount of life insurance. Okay.
Yeah.
And what the generation 1 retains is a note where she's to be paid back the greater of that premium that she loaned or the cash values in the policies. But that note doesn't become due and payable until the death of the insured, which are her younger children and their spouses, right? So when she dies holding that $30 million note receivable, you have to do a valuation of it. What's it worth today? What's it worth in today's dollars? If she's entitled to $30 million, but it's not for 32 years, you get to squish that valuation down. So the asset that's taxed in her estate gets a significant discount simply because it's the duration before the asset is payable, right?
Okay.
And at the same time, we've funded a massive amount of life insurance inside these 3 split dollar plans in separate trusts. That's going to have a large death benefit to pay any estate taxes that the children may have to pass to the grandchildren, but it's also going to have massive amounts of cash value accumulation inside it. And you can actually, during the children's lifetimes, that money can be accessed and used for grandchildren and so forth. So a lot of times when generation 1 at that level of wealth, their focus is not necessarily on their kids because their kids have their own wealth. It's they want the assets to go to the grandkids, right?
Right.
And so this is a way that generation 1 can feel secure that they're going to fund this plan that's ultimately going to wind up in the hands of the grandchildren, which is where they ultimately want it to go. And if she were to just give money, skip generation 2 and give money to grandkids, that's another tax she's got to pay. So this is a much more efficient way to make that movement of wealth from generation 1 to generation 3. Another thing that I've noticed too is that generation 2 is oftentimes the driver of the transaction because they know they have this estate tax problem, but they don't want to deal with it for the reasons that I mentioned before. They don't want to have to spend $600,000 a year in pay life insurance premiums. And if you ask them, well, if we could use a few $1 million of your mom's money to do that for you, would you be interested in that? And they almost all say, of course, I would much rather solve my problem than create more problem, right? And they don't need G1 money, right? But it's too expensive to get it from G1 to G3. So it's usually driven by generation
tax. Is that what you're referring to? The GST tax, generation skipping tax from G1 to G3. Right. And what do you hit with percentage-wise with that kind of a tax?
It's basically a double estate tax.
Double? So
it's like another estate tax. So if she's going to pay 40% tax to leave the generation 1, there's another 40% tax to go to the generation 3.
Yikes. So bad plan. We're going to do a different plan, which would be a good plan. And using the numbers that you had described, just so I can say it back to make sure I'm understanding this, we have generation 1. We're talking about this 70 million, let's say. They already used up their exemption. 3 grandkids, we take $10 million slices. We put that into this type of loan regime or as economic benefit.
If you have spouses, we use the economic benefit is the preferred method, and depending on the age of the insureds.
So we'd be taking $10 million each, let's say, out of G1's estate, put into a split dollar economic benefit loan regime. That's going to put money into a trust. The economic benefit of that $10 million, or in this case, $30 million across the 3 grandkids, in today's dollars is worth zero because life expectancy is 30, 40 years into the future for
Well,
those kids.
economic benefit's a different thing. The receivable is worth not very much. The economic benefit is the cost that the insureds, those trusts, pay back to generation one. They have to pay for the value of that insurance. But economic benefit, when you have it in two insureds and they're young, we did a $72 million life insurance policy on a 54-year-old and 52-year-old. So the economic benefit the first year for 72 million was something like $800. So that's the cost to the strategy back to generation one. The loan regime is interest, right? So you have to pay the interest.
Yeah.
So the interest rate is 5%. That's a big number, right? So the economic benefit regime is the better choice in that circumstance. Jay, I think you'd agree.
I totally agree. And I would say in the loan regime, and it's all facts and circumstances, but the interest can either be paid back to generation one or it can be accrued into the note. You'd have that option as well.
And so we get the full, in this example, the full 30 million out of the taxable estate of G1, and the let's say net return coming back into G1's estate is going to be A, the interest, or B, the economic benefit of the future value of the note. Am I saying that correctly?
Correct.
Wow.
So when you use this, the lawyers that we work with, the favorite aspect of the transaction, particularly when you're using an economic benefit, is they refer to it as an interest-free freeze. So it's an estate tax freeze, which you take assets and move them out of your estate so they can grow out of your estate. So you want to freeze the value of those assets in your estate. We have to charge interest on it if you make a loan, and it's expensive. When you use economic benefit split dollar, the cost to make that freeze is so small that it's almost free. And so it's like interest rate free, estate tax freeze strategy. So lawyers will tell you, even if all the other benefits that we talk about really don't come through fruition, you've gotten the benefit of this estate tax freeze for extremely low costs.
Yeah. So I can see very clearly the benefit to G1 from a tax perspective, right? We knock off another 30 million and get it outside the estate tax problem. Jay, maybe let's go a little bit deeper on the benefit to G2. So we have these insurance policies set up inside this trust, funded by this split dollar arrangement from G1 into the trust for G2 and G3's benefit. Talk me through, what does that actual benefit look like for that second and third generation?
Yeah. So what Jason and I see, especially with the ultra high net worth families, the 100 millions and plus, right, is that they have these gift cards, the $15 million each this year, right? But once that's gone, then their tools in the toolbox, there's not much you can do. And invariably with these larger families, they've already established trusts for generation two, right? And oftentimes they're not generation skipping. However, we do see a lot of times where the trusts established for the second generation are not generation skipping, which means upon their passing, they're going to have an estate tax problem. So think about when G1 passes, they're going to get the residue of G1's estate plus those non-GST trusts, which in fact is going to create their big problem. So having the death benefit on their lives helps their heirs or generation three have the liquidity to pay the tax. That's the first thing. The other thing we found too is that, and this is very common with families that make large gifts, is it's kind of like, do I want to wait and give my kids all the money when I die, or can I watch them and enjoy it while I live? Right. So some of these trusts have provisions where generation two can actually get at the money for health maintenance and welfare and so forth. But maybe they want to buy a business inside of that trust instead of their estate. So the other utility of the death benefit on the second generation is, Jason and I call it, leaving the campsite better than you found it. Because ideally, if generation two starts to spend some of the money that they're a beneficiary of anyway, it's their right, then some of the death benefit that they leave their children could actually replenish the wealth that they took out to build businesses or build homes or second homes or whatever.
Interesting. So we effectively are creating a system in which we're taking money from G1, putting it into this structure, and then because of the two aspects of the insurance policy itself, right? The death benefit, which is going to be paid income, and in this case, because it's outside of the taxable estate tax free, to in this case it'd be generation 3. But also generation 2 has access to the values of those contracts, the cash value in this example. Is that correct?
Can be. It depends on the terms of the trust. If the trustee has the ability to take a loan out and loan money to generation 2, it's certainly something you can do. One of the J there's a lot of benefits to generation 2 and ultimately generation 3, but I think the main benefit, if you just put yourself in that situation, if you know you have a liability, say you're a wealthy person, and I got to take care of this tax liability, what's it going to cost me? And you can say, well, it's going to cost you this amount of money per year. And we're going to have to transfer an income producing asset, or we're going to have to do some additional estate planning techniques to get the funding source for that premium in the trust every year. And so there's all this complexity to that. Whereas if you could just go say, oh, by the way, if you don't want to do any of that, if you don't mind giving up some of the money you're going to inherit from your parents, we can use their money to do this for you. And you don't even have to send a crummy notice. And so it takes out 10 steps of the process for generation 2. It makes their life simple.
Yeah. So would this fall into a category of fairly common, let's say middle of the fairway strategies that wealthy families are out there and are using? Or is this hyper niche and not too many people know about it?
I don't know. Jay, what do you think? I mean, it's being done, and we've done them. It's not something that is happening, I would say overly frequently. But it's like I said, there's a special circumstance where it is really effective. And if you have a generation 1 that's not insurable, has a tax, you got a generation 2 that's wealthy on their own, then it's just one thing that if you're talking to advisors, you're trying to solve the problem that exists for generation 2 or generation 1. It's just one arrow that you could put out there and say, this is a strategy that we've done in the past that's worked very effectively. And we actually have some positive court cases from the Internal Revenue Service on it. So I don't know, Jay, I don't know. I wouldn't say it's something that's as common as a GRAT, but it's not completely uncommon. It's not like a unicorn.
Right.
Yeah. And I would say that the typical family, G1s are definitely older, 65 and plus. They've done all their planning, no exemptions left. They give their kids their annual exclusions, and they go to their lawyer and say, I still have a $100 million taxable balance sheet, and the IRS is my silent partner at 40 or 50%. What do I do?
Yeah.
So this is just one idea that they can compare to status quo. We always do what the families say. If you do nothing, here's the costs and consequences of doing nothing. And then we show them this. And then I'd find that about 50% of those big families say, you know what, I'm not going to have an estate tax because I'm going to leave my whole estate to charity. Well, a couple of things is that the death benefit that is ultimately placed on G2 can actually replace the wealth down to their grandkids because technically that wealth that was otherwise going to go to them went to charity.
Right.
So it's just repositioning their social capital that they really don't control, but now they can control it where it goes.
Hey, it's Alden Armstrong, the head of product and case design here at Better Wealth. If you're a high earning professional, an entrepreneur, or someone who wants to just take more control over your money, we offer a clarity call. It's a one-on-one conversation where we get to know you, your situation, and advise on whether or not life insurance could help you build a safe, liquid, and tax-advantaged financial foundation. No pressure, no fluff, just a real conversation with an expert to assess if this strategy is right for you. Click the link in the description or comment below, and we'll walk through how we can help you. Back to the video. Yeah. It brings to mind something. I think I've seen a presentation of Jason's in the past through a mutual friend of ours, Laura. And one of the slides had an example of, all right, this is your estate tax that you will owe upon your passing. It's approximately $50 million. If paid to the IRS, that funds the U.S. government for about less than a minute. It's like 30 seconds or something crazy like that.
Yeah.
And then you juxtapose that with now what kind of an impact can 50 million have on a charity? And oh, by the way, let's replace it so that your family benefits 2-3 generations in the future because of the insurance, and we're leaving a massive impact from a charity perspective. There are many different charitable vehicles, but private family foundations that we've talked about on the channel before, charitable remainder trust, these other types of vehicles for people who want to preserve their wealth and make an impact. This seems like a fantastic way to do both by preserving it, allowing the rest of your wealth to just skip Uncle Sam and go directly to making an impact. That's really powerful. Yeah.
The only other thing I would say that's a byproduct of this, and I can't speak for Jason, but we're hearing a lot from families, especially with the exemptions have gone so high, right?
Yeah.
Is think of the tax cycle of a wealthy family. Let's say that they owned a business and they paid income tax on their earnings, and they paid income tax maybe on their S distributions. They sell their business. Now they have to pay capital gains. They reinvest the money into taxable securities. Now they got to pay taxes on that.
Mm-hmm.
And then when they pass, they got to pay excess tax on, above the exemptions. And so what we're hearing, especially from these big families, is maybe not necessarily worried about the estate tax, because if you bring in charity, we know that it can actually be voluntary.
Yeah.
But they do grouse all the time about the income tax.
Yeah.
So the other benefit about this is when Generation 1 makes that loan into the trust to buy insurance on Generation 2, those cash values grow tax-free. And typically these trusts are grantor trusts, which means that the tax liability falls back to Generation 1. You can make the argument that paying the tax is great for Generation 1 because it reduces their estate tax, but at the same time, those dollars are going to the government.
Right.
And so that's just, a byproduct of this as well.
I want to go back briefly to the IRS came up. You mentioned a couple of court cases. Is there, for this type of strategy, is there a private letter ruling that's on the books for this? What's the precedent behind you being able to recommend this to a wealthy family?
Well, it's better than a private letter ruling. There's actually a tax court case from 2022, which I was involved with. And so it's the state of Marion Levine. That's the case that the court basically went through every aspect of the split dollar arrangement plan, how it was designed, how it was structured, and ultimately upheld the strategy as legitimate. And so it really serves. I would say this strategy has gotten more popular since then because the Levine case basically kind of lays a roadmap out on how to do the strategy. So you've got a pretty good authority on how to behave and design your plan. So it has, it's going to be respected. The only issue that should exist really is what's the value of the receivable. Right? And so if you do the transaction, we model these and we'll show 0 discount, right? But even on a 0 discount on the receivable, so all that money that value is pulled back in the estate, the transaction is still massively accretive to the second and third generations, but there's going to be some discount, right? Because it doesn't make sense for there not to be. So that amount can move up and down. It can be, 80%, it can be 50%, it can be somewhere in there. I think Levine's was somewhere around 70% discount. So you're going to get a discount, but even with no discount at all, the strategy works very well. But that's really the only thing that's a variable. If you design the plan the right way, you've got certainty as to what your economic benefit costs are. You've got certainty as to the amount of insurance you can buy. All those things are clear. The only thing is the unknown. What's the value of the receivable? Which is determined down the line.
And I would imagine a case like this, as you're putting it together, and with your experience working in the Levine case, from first conversation to implementation, how long is this process?
I'm working on one right now. We've been working on for 18 months.
Yeah.
So it takes a little while.
While. There's a lot of moving pieces, and when you're dealing with that much money, and Uncle Sam's really wanting it, and you want him to have it. It's a process.
It's not because it takes that long to do the process. It's just working with those types of families. And Jay is certainly had this experience. It just takes a good bit of time to get things done, to gather the team together, to meet with all the different players that are involved. Things just take some time, and they're wealthy, that are traveling, that are enjoying their wealth. So it's important to them to do, but it's something that's not necessarily urgent in their mind.
Gotcha.
So that's why it takes some time to do.
So it's more on the side of the client instead of on the side of the paperwork, the logistics, everything else that comes on the advisor team.
Right. Yeah. Would you agree, Jay? I mean, drawing and split dollar agreements and the papering the transaction shouldn't take very long at all. It's just getting everybody engaged, understanding transaction, what happens. You have the insurance component, the underwriting that has to be done. That takes some time, so there's a lot of moving pieces to it, but it's primarily just getting everybody to understand, comprehend the process and say, okay, let's go get this done. Right.
Agreed.
Incredible. Well, for landing the plane's sake here, let's just walk back through this strategy from beginning to end in this diagram. So we have on the left-hand side, generation one. They are creating an ILET, which is an irrevocable life insurance trust, something very specific to the type of insurance design that we're doing. It is irrevocable. So once money is in it, it's outside of a taxable estate. And then we're also creating a non-equity split dollar arrangement using, as Jason outlined earlier, an economic benefit regime. That's what we're calling the split dollar agreement. It's between generation one and the ILET. There's your split dollar agreement. Second part that happens, generation one now loans through a loan directly to the ILET, the premium required for the insurance policies. Those insurance policies are going to be placed on generation two with those loan proceeds. And then coming back around, we now have the split dollar arrangement, after split dollar agreement. The ILET pays the economic benefit cost to generation one. So this is what we were talking about before from a discounting perspective, how much of that total premium can be removed from the taxable estate. Jason mentioned that perhaps modeling none of it is going to be removed, and let's see how it actually plays out. But we apparently are able to get a good amount of discount.
Yeah. And that number 4 slide, Alvin, is the amount of the economic benefit cost that needs to be paid annually back to the trust. So that's that
annual
very
interest,
small,
right?
That's a very small calculation of it's basically what's the true cost to buy the insurance. So if you think about how do you calculate that is what's the likelihood that the insured's going to die in that year? That's how you use to calculate the economic benefit. And if you have two insureds, then it's what's the likelihood that both insureds die in that year. That's why the economic benefit amount is so low. Like I said, it was like $800, that massive insurance policy. So that's the tax-free component of the freeze, if you will.
Got it. So that section, so number 4 there, that's the interest aspect, either being paid annually back to G1 or, to Jay's point earlier, carried within the note itself.
Right.
Correct.
Okay. At the death, so this is going to be death of generation 3. Is that what we're talking? I'm sorry, generation 2. Excuse me. Policy proceeds are paid back to the ILET for the benefit of generation 3. And then finally, split dollar receivable paid back to G1's estate at that time. So maybe talk to me about number 6.
Well, typically in this, Jay, you can jump in if you want to, but typically that receivable is going to, generation 1 is going to predecease generation 2. Okay. So that receivable, if they don't, right, if generation 2 dies while generation 1 is alive, that note is due and payable, right? So that all that, the principal value of the note is going to be pushed back into G1's estate. That's unlikely to happen. So what's more likely to happen is that note becomes an asset of generation 1's estate when they pass. Okay. And during that process, when the estate tax is filed and the audit's done and the valuation of that receivable is set, then generation 1, as part of their estate plan, can leave that receivable to either this ILET or to another ILET, and they can be merged or can keep it. Like some people leave the receivable to the family foundation, but it's simply something that's going to be valued in the generation 1's estate and either acquired by the islet through some transaction, either by her leaving it through her will. And if if the islet acquires it, then the note is extinguished. The obligation goes away because you have a merger. If you want to leave the receivable to the family foundation, you can leave it to the family foundation. And then when G2 dies, family foundation is going to get the money. So it's really up to the individual family, what they want to do with it.
Yeah, so it's a complex structure, but still gives a lot of flexibility to how the ultimate end works out for that particular family. It doesn't have to be decided at the beginning.
Typical design is you want to extinguish the split dollar agreement at some point in time, right? And the way that that's done is that you have the note holder and the note maker become the same person. So the note goes away, right? By law, it's called a merger. So it just terminates. So the transaction ends at that point.
Okay. Wow. Well, overall, I think the strategy is incredible. It's very interesting to be able to see how the ultra wealthy, the affluent families are able to do these types of things. And this is just, like you said earlier, it's one arrow in the quiver of all the different estate planning opportunities out there. But I really appreciate you both being here to walk through this. Is there anything else that you want to add? Clarity that we didn't cover, examples that you want to give before we land the plane here?
The only thing I would say is, and I like to give Jason accolades, but he has created a one-page template that he allows me to use as his study group member. And it basically just shows the family on the left-hand side. Here's if you do nothing. And then the right-hand side, a few columns that show this strategy so they can see clearly year over year the advantages to the structure.
Right.
And so it's hard in a YouTube, and some of this stuff is so esoteric, but when you get to that point, that's how we clearly communicate and compare and contrast staying put or doing something like this.
Yeah. It's incredible.
Yeah, I would agree. I mean, when you can actually sit down with the family and look at actual numbers, and they can look at a sheet of paper and, you know, see what the relative benefit is relative to the cost, it's typically something that they're interested in pursuing.
Yeah. I mean, when you paint the picture like this, what is a reason that a family wouldn't want to go forward with this?
Well, there's any number of reasons. I don't know if you can answer that question, but I mean, we did show the family that from the beginning of the first premium loan until everything to generation 3 was better from the first year, right? If she had died that year and generation 2 got the money and went to generation 3, putting it into life insurance policy, it was better to generation 3 from the first day, right? So there's in that scenario, there's not really a reason to not do it other than just reluctance to complexity, like, I guess.
Yeah. And something we've handled in-house is the idea of doing insurance on multiple generations. So G1 doing insurance on 2 and 3. So outside of structures like this, maybe using a more simplistic ILET, but no split dollar arrangement. The thing we've run into is everybody that's involved has to be on relatively the same page, right? Singing the same tune, rowing the same direction for underwriting to take place, for the ILETs to be drafted, for all the signatures to happen. And so now you mentioned it can take up to 18 months. That's what you're currently working on with one of these cases now. It's across the board. It sounds like these types of situations involving multiple people, multiple generations, they will go much more smoothly if there's some cohesion in that family unit with, this is what we're doing, this is how it's working, now let's all get on board. The more fractious the relationships within the family, we've had some cases fall apart because some people just don't want to be involved. And so I'm sure that's hard to navigate from any degree of wealth.
Yeah. And insurance is something that people should do, but they don't have to do it. And, so it's, and particularly when you're that wealthy, you have, should you do this economically? Yeah, it makes sense, but do you have to do it? No, you don't have to do it.
Yeah. And one of my mentors said that insurance is always a want and it's never a need. I think that's pretty darn accurate. Well, Jason, thank you so much, both of you guys, for your time. I think this
Thank
is going to
you.
be a great episode. And any other final closing thoughts?
No, just thank you for your time, and
Yeah.
always good to see you.
Good luck to you and your bride.
Oh, yeah.
Sure.
Baby number 3. Woo! Here we come.
That's good.
Appreciate you guys.
Thank you.
Okay.
Rise up.